Right, so the next set of exemptions relates to investment income, and this specific video is going to deal with interest. So the mind map that you're going to be looking at is the one that reads Unit 3, Subunit 3 Exemptions, Investment Income, SANP 3.4.4. Right, so at this one there's two exemptions that you need to know. The first one is known as the Basic Interest Exemption, Section 10(1)(I), and this section number you also need to know, and this exemption is linked to age, but firstly important, it has to be South African interest. So very important, there's no exemption in our tax legislation for interest from a foreign source. So whether you're a resident that receives, or is taxed on worldwide income, if you receive interest from another country, that foreign interest will not qualify for this specific exemption. There's no exemption for foreign interest. So this basic interest exemption is only available for natural persons, but it is available to both residents and non-residents. But it has to be South African interest, and it is dependent on your age. So if you are under 65 years of age, your exemption is 23,800 Rand, and if you're 65 years or older, your exemption is 34,500 per year. It doesn't matter, whether you receive only interest for a part of the year, that is the annual amount that could qualify for an exemption. So again, remember, you include the interest into gross income, and then you provide the exemption, in this case based on age. I also just want to remind you that for non-residents, we won't immediately look at this one first. We will always consider Section 10(1)(H) first. That first one we did in class on Tuesday, because it gives a total exemption if they comply with the requirements. If they don't, then if it's a natural person, we can look at the basic exemption. Then excluded from the basic interest exemption is any interest that is exempt in terms of Section 12 capital T. Now, ladies and gentlemen, Section 12 capital T is also a section number you have to know, and this was introduced a few years ago to encourage South Africans to save a bit more, your average households to save a bit more. And how this exemption works is that if you receive interest or dividends, for example, from an investment that is classified as a tax-free investment in terms of Section 12T, then the entire amount is exempt. It also has additional tax benefits. If you dispose of a tax-free investment, for example, there's no dividends, or there's no capital gains tax, and there's also no dividends tax. But the important thing is it must be interest or dividends received from a tax-free investment. Now, you can have a look at what is the requirements to qualify for the exemption. You can read through that. Please note that in tax, we will always tell you, right, the decision was made to tell you that this is from a tax-free investment. So you don't have to study the theory relating, who qualifies or what qualifies to be a tax-free investment. You just need to know that if an amount is received from a tax-free investment, the exemption is given in terms of Section 12T and not in terms of the other ones. But, and there's a big but here, right? If you invest in a tax-free investment, SARS is very clear that there are annual limits. So, in a year, you cannot invest more than 33,000 Rand per year. And in your lifetime, you can't invest more than 500,000 Rand in total. And this is sort of to discourage people to, abuse these provisions, your high net worth individuals to, take all their money and put it in these tax-free investments so that they don't pay any tax. The idea behind Section 12T is to encourage your average person in South Africa, or somebody that struggles a bit more, maybe is a bit poorer, to be encouraged to save, because there won't be any tax implications in terms of it will be exempt. So you're only allowed to per year contribute up to 33,000 Rand, or invest up to 33,000 Rand, and in your lifetime 500,000 Rand. If you exceed these limits, then whatever exceeds that 33,000 Rand or the 500,000 Rand is subject to a penalty, and that penalty is 40%. So let's say, for example, I invest 40,000 Rand into a tax-free investment, but I'm only allowed to invest 33,000. Then on that 7,000 Rand excess, I'm going to have to pay a penalty of 40% to tax, and that 40% is deemed to be normal tax payable. In other words, it doesn't affect your taxable income calculation. It is pure tax of 40% that you will need to pay over to SANP. So if you open up your study guide and you go to case study 4, we have a Mr. Z, 66 years old. He made 2 investments on the 1st of March of the current year of assessment, in other words, 2019. And then we have investment 1, 500,000 Rand was deposited into a 32 money market account with ABC Bank, and investment 2, 45,000 Rand was deposited into a tax-free investment. Now, if I look at that information, there's 3 things that I need to look out for. The first one is this guy is a natural person and he's older than 65. Now that immediately should trigger, okay, wait, if we look at the basic interest exemption, you know, there's, instead of 23,800, I'm going to have to use 34,500. Then investment 1, there's a regular 32-day money market account, but investment 2 is a tax-free investment in terms of Section 12T. So I have to consider the provisions of Section 12T. And what I want you to notice is that he deposited 45,000 Rand into this tax-free investment, and we know that we're only supposed to, in a year, deposit 30. Oh, this doesn't look too pretty, but 33,000 Rand. Then they tell you that the following interest accrues to Mr. Z during the current year of assessment: interest on the money market account of 45,000 and interest on the tax-free investment of 2,500 Rand. And we have to determine what the effect on his taxable income for the 2019 year of assessment is. So there's essentially 2 transactions here. There's the first transaction where the investments are made, but that is a cash outflow or a capital outflow. So we will consider the deductibility thereof next week when we start looking at general deductions. But then we have to, for this specific case study, look at the effect from a gross income and exemptions perspective. So because he's a resident, he's taxed on worldwide income. So the money market interest goes into gross income 45,000 Rand, and because he is older than 65 years, of that 45,000 we exempt 34,500. Something to keep in mind is that SARS will not allow you to exempt more than what was actually received. So if, for example, instead of 45,000 Rand, he received 10,000 Rand, you won't include 10,000 and then exempt 34,500. The exemption is always limited to the gross income inclusion. So if it was a 10,000 Rand inclusion, then you would only exempt 10,000 Rand. In terms of the tax-free investment, the 2,500 Rand, it's not the basic interest exemption that gives this one. It is Section 12T, and we give the 2,500 Rand to leave us with income of 10,500. But we're not done, because the problem is that he exceeded his investment limit of 33,000 Rand per year in terms of the Section 12T tax-free investment, because he invested 45,000 Rand. So we have an excess of 12,000 Rand, and this is subject to a penalty. Now remember, a penalty is not supposed to be nice. It is not supposed to make the taxpayer happy. It's supposed to make the taxpayer sad. So he's going to pay a penalty of 40% on that 4,800 Rand penalty, a penalty of 4,800 Rand, sorry, penalty of 40% on the 12,000 Rand. And that 4,800 Rand is deemed to be normal tax payable. In other words, that's tax he has to pay over to SARS. It's not gross income, it's not an exemption, it's not a deduction, it doesn't hit the framework at all, it simply hits our normal tax payable. So that's an additional 4,800 Rand in tax that he will be paying. Right, so that concludes interest. Next up, we will look at the exemptions in relation to dividends.